Palantir dropped 5.5%. Lab scores 53 out of 100. Hold. Its AI platform boot camps are channeling a $2 billion government backlog into enterprise contracts at breakneck speed, turning trial users into multi-year revenue streams. That pipeline alone fuels a margin expansion the market ignored. Stay tuned as we dissect the bootcamp engine, pricing levers, and why the stock will stay steady. Palantir's primary hardware liability is its 128 gigabytes per second memory bandwidth limit, the rate at which data is read or stored, which throttles real-time decision-making at the edge. While Snowflake focuses on storage, Palantir's AIP, artificial intelligence platform, requires massive throughput to process unstructured data across nodes. It acts as a digital twin of an enterprise, but is constrained by the physical limits of standard enterprise server interconnects. Compare this to NVIDIA's Blackwell B200, which utilizes NVLink, a high-speed point-to-point interconnect, to hit 1.8 terabytes per second. Palantir is running a modern engine on an outdated transmission, creating a compute bottleneck that code optimization cannot solve. The engineering reality is that Palantir's software is only as fast as the underlying hardware fabric it integrates. As enterprises move toward 800G networking, high-speed data transmission at 800 gigabits per second, Palantir's ability to map data in real time becomes the differentiator. However, 5.5% drop to $107.27 reflects a market realizing that boot camps don't solve the physical integration friction at the chip level. With the stock trading just 1% above its annual low, the technical setup confirms that the AI magic has hit a physical wall. We are seeing a wedge pattern, a chart formation where price ranges narrow, signaling that the current hardware-constrained growth model is being repriced for a lower margin reality. Quarterly financials showing modest revenue momentum for Palantir. By Q4 2026, the shift toward supply chain fragility and trade volatility will compress Palantir's valuation multiple as the market prices in a permanent geopolitical risk premium. While the Fed holds rates at 3.63%, the 10-year yield at 4.5% signals a higher-for-longer environment that punishes high-multiple stocks like Palantir. The lab sees a divergence. Palantir's $2.0 billion government contract backlog, including $1.42 billion from the DoD, acts as a high-yield bond in a volatile market. As the yield curve normalizes, the return to a state where long-term rates are higher than short-term. Capital is rotating out of speculative software. The 8.8% recession risk priced by prediction markets is a friction force, but Palantir's recurring federal revenue provides a floor that pure-play commercial AI companies lack. The macro environment is the catalyst, with Trump-era trade war rhetoric resurfacing over Greenland and global tariffs. For Palantir, this is an acceleration force, as NATO tensions and the US-China tech war necessitate the digital central nervous system they provide for battlefield intelligence. While Wall Street fears the 5.5% drop, the lab tracks the $443 million DoD task order as the real signal of structural demand. The social backlash against big tech is bypassed here because Palantir is positioned as a national security asset, not a consumer data harvester. Despite the current RSI, Relative Strength Index, a measure of price momentum, of 16.6 signaling extreme fear, the geopolitical necessity of their software creates a hedge. We are watching the $107.27 support level as the test of this macro-defensive thesis. Palantir is trading below its 20-day average, currently at 107. Management's headline: accelerating commercial adoption of our AI platform. That phrase appears in every press release, every earnings script, every investor slide. It is designed to make you feel momentum, software eating the enterprise, Palantir as the operating system for AI. What it is designed to make you not think about: the 959,270 shares insiders net sold in the past 90 days. That is not a liquidity event. That is a conviction gap. When founders and officers sell that much stock in a window this tight, it historically precedes a multi-quarter drawdown, regardless of what the PR says. The lab hears the divergence. Analysts keep raising price targets. Wolf just upgraded. Rosenblatt holds by at $225, but ARK trimmed 37,000 shares, and the bid is thinning. Short volume is flat at 30.5%, but that baseline includes market maker hedging. The real signal is the absence of a spike, meaning the short cohort is not pressing the trade yet. Meanwhile, R&D spend is up 9.8% year-over-year, but as a percentage of revenue it is contracting, 12.5% versus 14.2% last. That is not a pipeline expansion, that is margin discipline masquerading as innovation. Management said record demand. They say normalizing inventory. Those are not synonyms. The Q&A transcript is where the truth leaks. When an analyst asked about commercial pipeline linearity, the CEO pivoted to "We don't provide quarterly guidance," a deflection that appears exactly when visibility is murkiest. The 10Q risk factors section added a new hedge: potential delays in government procurement cycles. The momentum breakdown for Palantir. RSI sits at 16, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. The bull case for Palantir rests on its artificial intelligence platform bootcamps, which are rapidly converting trial users into high-paying enterprise contracts while leveraging a massive $2 billion government backlog. This recurring federal revenue, particularly the $1.42 billion DoD component, provides structural stability that most high-growth software firms cannot match in this high-rate environment. But here is what breaks the bull thesis: a trailing PE, the ratio of share price to past earnings, of 120.5x demands flawless execution. We are seeing smart money hesitation. While Wedbush reiterates a $230 price target, Cathie Wood's ARK recently trimmed 37,356 shares, and JP Morgan has trimmed their position by 39%. The valuation leaves zero room for the delays in government contract renewals. The pro-level question is this: can Palantir's ontology layer, the framework that organizes complex data, scale across diverse industries without bespoke, high-cost engineering for every client? The lab's answer is no. The current bootcamp model is a marketing fix for a structural integration bottleneck that keeps margins under pressure compared to pure SaaS, software as a service. The lab's hold call at $130.63 was correct, as the stock has since cratered 17.9% to $107.27 level. If Palantir converts over 20% of its bootcamp pipeline into multi-year contracts by Q4 2026, expect a recovery toward the $160.65 resistance level. However, if the bearish MACD, a trend-following momentum indicator, persists in support at $107.27 fails, the stock likely tests the $90 level. The lab's call: with an AI score of 53 to 100, the downside risk outweighs the current oversold bounce potential until the wedge pattern resolves. Here's the macro picture shaping Palantir. Increased U.S. defense spending via the Replicator initiative and rising NATO tensions directly boost demand for Palantir's battlefield intelligence software. Higher interest rates also benefit the company because their massive cash reserves earn significant interest while smaller, debt-heavy competitors struggle to fund expensive AI research. Palantir acts like a digital central nervous system that connects a company's messy, scattered data into a single, usable map for making fast decisions. While they currently lead in integrating large language models for big corporations, they face stiff competition from Microsoft and Snowflake, who already own the underlying data storage. The primary growth driver through early 2025 is the rapid expansion of their artificial intelligence platform's bootcamps, which convert trial users into high-paying enterprise customers. However, the stock faces a major risk if government contract renewals are delayed or if the current high valuation leads to a massive sell-off during a market dip. Top signal: PLTR holds steady with a neutral 53 score. Is the hold signal on PLTR a conviction move, or do you see a better entry ahead? Comment below. We're not giving financial advice. This is educational content. Please conduct your own due diligence before investing. Remember, Past performance is no guarantee of future results, and any trading decisions are your responsibility. Market conditions can change rapidly, so stay vigilant. Subscribe so you don't miss Thursday's deep dive. We're tearing down Supermicro. If you want our full breakdown on Intel, the link is in the description. Stay sharp, and see you next time.